So welcome again. Our topic was IAS 16 property plant and equipment, and heading is the revaluation of depreciable asset. So process of revaluation of depreciable asset is first restate the asset to its fair value, the same step involved in the non-depreciable asset. Second, remove accumulated depreciation by recording it as debit. Then you need to compare the carrying value with the fair value. If the fair value is greater than the carrying value, it would be recorded in other comprehensive income in the name of revaluation surplus. And if the fair value is less than the carrying value, difference would be recorded in statement of profit and loss as an expense. Depreciation of a revalued asset. For the calculation of depreciation of a revalued asset, the formula would be revalued asset or revalued amount divided by remaining life. Next thing, if as a result of revaluation there is an increase in the depreciation expense, how it should be recorded? If as a result of revaluation there is an increase in the depreciation charge, this is said to be, in other words, as excess depreciation. Now it depends on company's policy. The most often policy given to us in the question is that the excess depreciation should be transferred to retained earning on yearly basis. Or you can say the wording would be different, that the excess depreciation would be transferred to retained earning as the asset uses. So in that case, if you have to transfer the excess depreciation to retained earning on yearly basis, you need to record the excess depreciation for that year by debiting revaluation surplus and crediting that amount to retained earning. This would be the entry to record the excess depreciation. Means, for example, if before revaluation the depreciation charge is 1000, after revaluation the depreciation charge is 2500. So the 1500 excess depreciation would be recorded as excess depreciation and it would be transferred to retained earning by passing this entry: revaluation surplus debit, retained earning credit. Now consider this with the help of example. Cost of building on 1st January 2001 is 1000. Useful life is 5 years. And on 1st January 2002, the building is revalued to 1200. This is the company's policy to transfer the realized portion of revaluation surplus to retained earning as the asset is used. Year ending date is 31st December. To solve this question, we need to consider show accounting for revaluation. Before revaluation, in the first year, in the year ended 31st December 2001, what is the depreciation charge? On 31st December 2001, depreciation charge would be recorded by passing entry depreciation expense debit and accumulated depreciation credit, and this would be recorded as 1000 divided by 5. 200 is the depreciation charge that has been recorded before the revaluation date. Now on that date of revaluation, the asset has already been depreciated by 200. So we will pass the entry of revaluation on 1st January 2002. First we need to consider that we have to restate the value of asset to its fair value. So the asset would be recorded, building would be recorded as debit by 200. How this 200? Because the value of asset has increased from 1000 to 1200, it has increased by 200. The second step is the depreciation already charged in the previous year, the accumulated depreciation should be removed. How it should be removed? By debiting that depreciation. And the sum of these two figures would be transferred to revaluation surplus. Now remember that this 400 is the difference of fair value and carrying value. This is the difference of fair value and carrying value. Fair value is 1200 while the carrying value of asset is 800. How this is ascertained? As the cost of asset is 1000 and in the previous year the depreciation charge is 200. So 1000 minus 200, the carrying value of asset at the date of revaluation is 800, the fair value is 1200. As the fair value is greater than carrying value, the difference would be transferred to revaluation surplus. Now, as the company has a policy of transferring revaluation surplus to retained earning as the asset use, means every year. So, we need to record this by passing an entry on 31st December 2002. First, you need to depreciate that asset, and the depreciation of after revaluation would be recorded by passing the same entry, depreciation to accumulated depreciation. The amount calculated would be recorded as 1200, the revalued amount, divided by remaining life 4 years. As 1 year has been elapsed on the date of revaluation, the remaining life on the date of revaluation is 4 years. So that is how the depreciation charge after the revaluation has been calculated. So it is 300. Now the question is how to calculate the excess depreciation. How to calculate this amount of excess depreciation? You can simply calculate this as a difference of depreciation expense before revaluation, which is 200, and depreciation expense after revaluation as 300. But IAS has mentioned the way to calculate the excess depreciation as revaluation surplus divided by remaining life. So the revaluation surplus at that date was 400 and remaining life is also 4 years. So this would give us a 100 of excess depreciation. Same you can consider by comparing the depreciation charge before revaluation and depreciation charge after revaluation. So on 31st December 2003, you would also pass an entry of recording excess depreciation, that is revaluation surplus, to retained earning. So this would be the entry to record the excess depreciation. And again, how to calculate that amount? This could be calculated as comparing the difference of depreciation expense before revaluation and depreciation expense after revaluation. But the better way in accordance with IAS is to calculate the excess depreciation, you have to divide the remaining revaluation surplus by remaining life. As the revaluation surplus in this question is 400 and remaining life at the date of revaluation is 4 years. So 400 divided by 4 gives you the same amount. Now we need to consider that if an asset has been revalued and as a result of revaluation its value has increased in the first year, but subsequently the value of asset has decreased as a result of revaluation, how it should be recorded? So continuing with the above example, in the next year the building is revalued as 500. So first we need to restate the value of asset to its fair value from 1200 of previous revalued amount to 500 of current revalued amount. So the value of asset has decreased, so building would be credited by 700, as the assets value has decreased from 1200 previous revalued amount to 500 new revalued amount. Now the next step is to record the accumulated depreciation. Remove the accumulated depreciation. Accumulated depreciation means depreciation charge in the previous year, and in the previous year depreciation charge is 300. Depreciation charge is 300. So this depreciation charge would be removed by debiting this. Now next thing is we need to remove the revaluation surplus to nil. We need to remove the revaluation surplus to nil. How much revaluation surplus we have? We had created a revaluation surplus of 400. We had created a revaluation surplus of 400. Revaluation surplus is created for 400, but as a result of transferring excess depreciation to retained earning, revaluation surplus has been debited by 100, means reduced by 100. So currently we have revaluation surplus of 300 in our books of account. So this 300 of revaluation surplus would be debited. Now the further decrease in the value of asset would be recorded in the name of expense, statement of profit and loss, and that is of 100. So this would be the entry if there is a increase in the value of asset as a result of revaluation in the first year and subsequently the value of asset has decreased. So depreciation charge, we need to further calculate the depreciation charge after second revaluation, and it would be at the date of second revaluation, the value of asset, the fair value of asset is 500 and remaining life is 3 years. So depreciation charge is 167 approximately. So now as a result of revaluation, there is no increase in the value of depreciation expense. Instead, it has been decreased.